But let's focus on the power sector. Power demand in India has surged 6% in February and 8% this year so far. Nuvama believes this summer expect prices to rise for 2 to 3 months. Subhadip Mitra, the Executive Director Power and the Power Analyst at Nuvama Institutional Equities is with us. Subhadip, good morning and thanks for joining in. So there was a 6% rise that we've seen in power demand in the month of February. But do you see that, do you see the sector build on to the gains in terms of more demand? What are the stocks in your coverage in your coverage universe where you think there could be?
Hi, good morning, and thank you for having me on the show. So yes, I think if you look at the fundamentals of the power sector, on an average, last 20-year average, you've seen the power demand growth range between 4% to 7%. 4% in, let's say, a very bad year, 7% in a very good year. I think even if you look at Power Ministry or CEA estimates of power demand growth, we are looking at the numbers being factored somewhere between 6.5% odd. So clearly looking at power demand growth sustaining in that 6.5% range. Typically, seasonally, you always see a spike in terms of peak demand going into the summers and later as the monsoon recedes towards, let's say, August and September. So those are the two seasonal spikes that are anyway awaited. But yeah, based on that, I mean, our sense is that the fundamentals of the power sector haven't changed. We are looking at reasonably strong growth continuing and the relative short supply situation continuing for maybe the next 2 to 3 years until the renewables and the thermal capacity pickup, which is currently in the ordering phase, catches up. So in this scenario, our take is that, much of the utility stocks were already overheated. We actually had, more downgrades than upgrades, barring an NTPC in the utility space, not really seeing much upside in any of the other names, primarily because most of the future growth seems to be already factored in. And for many names, let's say classic example like a power grid, although we are seeing a much higher capex build-up over the next 2 to 3 years, the earnings CAGR is back-ended, right? Because most of these projects are expected to commission, let's say, only 3 to 4 years down the line. And hence the CAGR is impacted. We actually prefer more names on the capital goods or the industrial names, which are the equipment suppliers or the EPC manufacturers who are coming into this space. So let's say names like BHEL on the thermal side, where we anticipate the 8 to 10 gigawatt of annual ordering to continue. BHEL has won almost like 100% market share in the current year, and we anticipate at least a 70 to 80% market share going ahead. Similarly, EPC names like Kalpataru Power, where we've seen, uptick in terms of order inflow on the domestic T&D side, as well as Middle Eastern orders flowing in. I think there is a re-rating in terms of PE that can happen for the stock since most of the issues of the past are behind us, and we are seeing uptick both in order inflows as well as strong margins. We also have recently initiated on relatively smaller name transformers and rectifiers, Trill, which is a high voltage transformer player. Now, what we understand from the industry is there is a shortage of high voltage suppliers in the market. You only have 5 to 6 key suppliers in the market, 3 MNCs and 3 Indian names, of which TRIL is one. And clearly seeing a lot of traction in terms of the high voltage capex that's coming in because of the renewable connectivity, because of which we are saying, okay, power grid capex might go up 2.5 to 3 times their current rate. So I think the near-term beneficiaries will probably be more of the equipment and the EPC suppliers. Whereas for most of the utilities, I think, the future growth and the green transition, much of it is probably already there in the price. Barring NTPC, we see some triggers panning out. Sorry, go ahead.
No, sorry. For paucity of time, I just want to squeeze in one more question. You've downgraded Tata Power and IEX. Is it only the rally, the valuation discomfort that is worrying you, or anything else?
So clearly, so both are, let's say, in a sense, different animals. So in case of Tata Power, while we like the business, we clearly see traction from the renewable transition coming in. However, having said that, I think the transition will take 2 to 3 years. In the near term, are we really seeing any large earning triggers? Probably not. You might see plateauing out of earnings probably for the next 1 or 2 years before the renewable piece actually kicks in and you start seeing the profit growth coming in. And again, at the current prices, we believe that most of that growth is already factored in. And purely from a valuation perspective, we felt that, Tata Power price was getting overheated, which is the reason we have a reduce on that name.
Okay,
For
we'll leave.
IEX, it's
Sure, go
slightly
ahead.
different. Yeah, sorry. For IEX, it's slightly different. It's more about the structural game now changing towards a scenario where power prices are anticipated to remain on the higher side. And typically, when you have higher prices, you tend to see volumes declining, at least on the exchanges, as volume moves towards more longer term contracts. And then on top of that, you have, the regulatory issues in terms of market coupling, etc., which has been talked about in detail. You are seeing some pilot projects on market coupling coming in. So as and when that progresses over the next, let's say, 1-2 years, you will probably see the market leader in the exchanges seeing, hits on volumes.
Okay, we'll let you go on that note. Thanks a lot for joining in and giving us your thoughts. That's the word on the power sector. But let's also take a quick look at what's happening in the market. In pre-opening, it's kind of quiet.